we're we're in a very classic short-term debt cycle in which there was an enormous amount of fiscal and monetary stimulation. A lot of checks went out and a lot of stimulation happened when there was the plunge in the economy. And so a lot of that has gone out. And then, of course, from the highly depressed levels, the economy rallied strongly, and it's encountering its cyclical constraints. In other words, unemployment rates are low, demand is high, money is plentiful. So we are in the second, on our way to the third year of the expansion. That's the middle part of the expansion. What that means is that as inflation pressures rise, because there's more money and credit chasing a limited number of goods and services, because there are constraints, that produces a higher level of inflation. And when that produces a higher level of inflation, that then leads the central bank to leads the central bank to tighten money and then start to curtail the creation of money and credit. And so what you're seeing is we're moving into that phase. That phase will mean a reduced number of purchases by the Federal Reserve, and also the beginning of interest rate rises. That phase of the cycle usually goes on a bit because touching the brake on the economy and raising it does not immediately cause a reduction in demand or credit growth that is enough to stop the economy. So you start to see that tightening. I expect that we will start to see that tightening. And then with that tightening, it'll start to have an effect. The effects come first in the markets and later in the economy. They come first in the markets because all markets reflect the existing level of interest rates. What an investment is a lump sum payment for a future stream of cash flows. And that stream of cash flows, in other words, you put up a certain amount of money, $100, and then you get a certain number of dollars back. And that might be 1 or 2% per year, and that comes back. And the markets reflect that. They calculate what we call present value, which means when they're looking out all that stream of payments, they look at an interest rate and then they adjust for that interest rate. The higher that interest rate goes, the more asset prices have to go down in order to provide a corresponding yield. So when interest rates rise faster than is discounted in the price, that causes the financial asset prices to decline. It also makes credit more expensive. And that is what curtails the demand. And when that demand is curtailed, that is what produces the slow up. It is a very difficult thing to do now because there's a lot of debt outstanding. There's a lot of assets are priced. Because of all the liquidity, assets are priced fairly high. And so there's a greater interest rate sensitivity than is normal. But that's the cycle. And so 2022 will be, I think, an adjustment period as you start to have that touching the brakes, but not turning that into an unacceptable downturn.